I never thought I'd be talking about this because we thought we'd loan too much money. Now people are saying there's not enough supply. People are looking for it. Where are we on the supply demand for credit?
Yeah, so there was no supply last year, or very little supply, anemic, as they like to say. I think what happened is that you saw a big bond market rally, obviously, sort of in the fourth quarter of last year. We came into this year, and the capital markets opened up for business again. People were feeling a lot better about the world. People felt like the Fed had sort of landed this, soft landing, I guess. And you can see it. The market's priced quite nicely for lots of cuts. And so you've seen a lot of supply. You've seen most of that supply in the high yield and loan markets and really high quality issuers. You've seen a lot of investment grade supply, and you've seen a lot of treasury supply. And I think that there's a couple reasons. I think one is that most folks are worried about the economy slowing towards the middle of the year. So the Q2 bottom is sort of what the narrative looks like now. So getting in front of that is number one. I think number two is there is a lot of demand for credit right now because absolute yields are relatively high, and so the market's open back up. And three, people are worried about the election cycle as you sort of move forward in the course of the year and whether that's going to create a lot of volatility, which will impact the ability to bring high yield issuers and loans to market.
So as a practical matter, if you have more demand for the credit, it drives the price up of the credit and it drives the yield down. It gets cheaper, as it were. Are you getting paid these days for the risk you're taking in credit?
So spreads in credit, if you sort of go up and down the stack, investment grade is sort of 100 over and high yield is 350, 360 over. Loans are low 500s over. Spreads are pretty tight in investment grade and in high yield. I think I saw a statistic today that high yield spreads were as tight as they have ever been post the GFC.
Wow.
So they're tight. Loans are not. Loans are sort of in the middle, non-recessionary average loan spreads are in the low 500s. That's where it sits today. I think the difference, and this is kind of the problem, is that yields are high and spreads are tight. And so when yields are that high, you have a little bit of cushion. If you're a little bit wrong on spreads and spreads back up a little bit and go out by 50 basis points or 100 basis points over a couple of years, so you're not making, 8 to 9% in high yield bonds, you're making 7.5 to 8.5% in high yield bonds. So I think that in the context of what are the options in the market today, credit's far more compelling than equities for a variety of reasons. Yields are pretty high, and rates, despite the short end coming in, are likely to stay somewhat elevated on the back end. So that spread plus the base rate gets you to a yield that kind of makes sense for people.
There's been something of a conversation going on between the markets and the Fed about exactly what they're going to do in terms of cutting.
Yeah.
How much they'll cut, how fast they'll cut. What is the market pricing in right now on that? And what happens if they're disappointed?
Yeah, it's two different conversations. Yeah. So the Fed dot plot is 3 25 basis point cuts. The market is pricing in 5 or 6 cuts this year, and that's a lot. Our view is that the market is kind of priced for perfection. So if the Fed were to deliver 6 cuts, the question is why. Yeah. And if it's a recession, that's not great. If the Fed doesn't deliver it, the market's expecting it and expecting it in the context of a soft landing. So there's not a lot of room for error. So if you have inflation spike a little bit and you have corporate earnings slow and you have companies repricing their debt at 300 basis points higher than they were. I mean, remember, companies since the 1980s, every time they've come back to refi has been a lower cost of capital. Mm-hmm. This is the first time it's a higher cost of capital. So there's risks in the market, and there's not a lot of room for error in terms of where the market's kind of trading today. What about that possibility of a troubled economy that would require that many cuts? I mean, we spent a lot of last year with economists and people saying we're going to have a recession, we're going to have a recession. Didn't happen. Now it seems like we're saying, no, not going to have a recession. Where is the credit market right now in pricing in the possibility of a recession? Not just a slowdown, but a recession. The credit market is not pricing in a recession. Spreads are as tight as they've been. And in fact, I was looking at some numbers. It's just an interesting notable that if you look back to the beginning of last year, spreads were close to 500 over on the high yield market, I want to say, versus kind of, we said 360-ish today. Treasuries were exactly at the same place. Wow. And when people are financing these days, are they moving over into credit away from equity? Because there was a time when you actually had to take less leverage, put more equity in to finance things.
because of where we were. Is that shifting now, given where we are?
It seems like there's a decent amount of demand for credit right now, for sure, across the board. I mean, ranging from treasuries to investment grade, because that's another way to play that rate trade, to high yield, to loans, to private credit. There's a lot of demand.
I don't know if it's a conversation or whether it's more of a tug of war between private credit and liquid credit, syndicated, things like that, with reports that the banks are trying to get back into that business, take some business back away from private credit. Are you seeing that?
Yeah, I mean, look, the markets, the supply in the markets there's been a lot of supply across loans and high yield bonds and investment grade in January. That supply has come through the banks. That's come through the banks because there are buyers that are back that are buying liquid credit. So you're definitely seeing that today. And if that trend continues, some of those big mega, I mean, there were mega deals that were done in the private credit space, that were $3 billion, $5 billion in size last year, that were really mega cap deals. I suspect that if this trend continues, you won't see as many of those mega cap deals. The rub is if it doesn't, and if there is volatility, and if the Fed doesn't deliver 6 cuts and they deliver 3 cuts, and if there's slower growth, this is going to go back the other way, because there's one variable, which is that there's a lot of companies in 25 that need to refinance their debt. And what that means is that they oftentimes come to market a year in advance of 2025. So you're going to see a lot of paper that actually needs to start to get refinanced in the marketplace. And so this question of whether the markets are going to sort of stay open, if you will, to allow for that to happen in the syndicated space is really the question that'll happen. And that's the relevant question for whether this private credit trend will continue.
Well, that's my question about the trend, because there's been at least a perception, you would know, that in fact private credit's been on the march. It's been taking market share, as it were, from the alternatives, from the banks,
yes,
from the liquid credit. Is that continuing right now? Is that shift still happening? Is it slowing down? Is it stopping?
It's slowing down in January, but I think that shift is going to continue to happen over time. I do. I think it's going to. I think it's early innings in that.
And how far can it go? I mean, how much market share can private take away from the banks?
How much more? Well, I mean, the estimates are that private credit's going to grow by 15+% a year.
Right.
So,
but it's still a relatively small portion if you look at total amount of loans, right?
It's 5% of all credit out there.
Exactly.
Yeah, totally.
So even if it's growing 15%, it takes a long time.
It takes a long time. But remember, private credit is not, I mean, there's been this narrative about it. It's not sort of credit out of thin air. I mean, as you said, it's credit that was underwritten by banks. Yeah. So that's one place. It's credit that was underwritten by syndicated investors. That's another home that it's coming from. And there's even, and we're seeing in some of the insurance companies, private investment grade. I mean, there's a lot of flow that's going to the land of private credit. I don't see what's going to make that stop.
What's mispriced right now, quickly?
What's mispriced right now? I think treasuries are going to stay anchored in this sort of 10-year 4.5%, which means that I think credit generally is a pretty good place to be. Yeah. I would say probably loans are more interesting just because we don't believe the Fed's going to cut that much. So that's probably an interesting place.